Well, thank you very much for being here, and thank you everyone else for being here. And welcome to this third session of Quantopian Book Conversations. So we are very honored and very pleased to have Professor Doyne Farmer with us, who is the director of the Complexity Economics program at the Institute for New Economic Thinking at Oxford Martin School, and Bailey Gifford, Professor of Complex System Science at the Smith School of Enterprise and the Environment at University of Oxford. Also, of course, for many years, external professor at the Santa Fe Institute here in the United States and chief scientist at Macrocosm. So I don't want to take too much time going through the introductions. In fact, he needs no introduction for this audience and beyond this audience as well. But this will be a conversation in general around the book that Doyne published this year in 2024 called Making Sense of Chaos, A Better Economics for a Better World. So I have here a list of questions, and I will also open this for the audience to ask questions. But if you're okay, Doyne, why don't we start by you telling us a little bit about the genesis of this book? And in the book, you said that it was something in the works for around 10 years, and how this came to be, how you were led to, or motivated or inspired to write this book. Just talking about the book and how it came to be, and we take it from there.
Yeah, well, I did take more than 10 years to write it, but the genesis really comes from when I was in graduate school. So, because the book covers a lot of things in my life and how the seeming unconnected pieces of science that I did in chaos and complex systems came together throughout my career. It sort of came together at the end as I began doing economics and found some applications for all those ideas. But so the book itself, I just realized at some point that I wasn't getting through to the mainstream in academic economics, and that writing a popular book might be a different way to communicate that could reach a broader audience. And so I set out to write that kind of book. And the problem is I'm just too busy doing research to find time to sit down and really concentrate. So I had to squeeze it out between vacations and sailing trips and other things. So that's why it took a long time.
This is actually one of the first questions that I had noted down after I finished your book and while reading the book. So you did emphasize many times in the book that this wasn't supposed to be criticism of the standard traditional, let's call it orthodox economics, that this is more of an offering of an alternative, and while pointing out the deficiencies or the issues and the problems with standard economics. So two questions that immediately, at least in my mind, come out of that is, do you see this as the new economics or new economic thinking along the lines that you outline in the book as a remedial approach to standard traditional economics? So there is basically a way to bring the two together while you take care of those problematic areas. One, and two, how do you see it being received, and why is there such a resistance to this?
Yeah, so those are really good questions. First of all, I appreciate you emphasizing that first point. I worked really hard. I edited all the parts that my colleagues perceived as negative. I just threw them out. And there are plenty of criticisms of economics. There's probably at least 30 books criticizing economics. But I wanted to focus on something constructive and positive. What is the alternative? And so I don't see it as remedial in the sense that I'm not putting band-aids or even fixes on top of traditional economics. We're really starting from scratch in a completely different way. And, making use of what we can make use of, but really small pieces, because we're really advocating a very different way of doing it, completely different. So the conceptual foundation is just different. Now, I think it can go along in parallel. There are some problems where I think traditional economics is the right thing to do. And it gives you a certain perspective. It allows you some conceptual tools. You can solve equations, which is always nice if you can reduce things to equations. But this is just a different approach that can go along in parallel. Now, the reception has been quiet, I would say is the right word. Occasionally hostile, but mostly quiet. I have some colleagues and friends who have received it well. My close friend, John Giannakopoulos at Yale, mainstream guy, wrote the entry in the New Palgrave's Dictionary on General Equilibrium Theory. he supports this approach, and I've written some papers with him. We've even written a paper sort of contrasting the two perspectives and their pros and cons. I was really pleasantly surprised that Larry Summers put an endorsement on my book. I
Oh,
actually sent it to him just as a courtesy because I mentioned his name several times. And he responded by saying, well, gosh, it's so nice of you to do that because normally people just trash me. But I was shocked that he'd read the draft and made detailed comments about many things that quite a bit improved the book. And he said he really thought I was onto something and that it's a good approach. So there are some unusual people, some of them fairly prominent, who have expressed positive support. But by and large, the mainstream has just been quiet. They've ignored it. And why? Well, for one thing, they've been hearing whispers about this for a long time, since the days of Herb Simon in the 60s. So one response is, well, you guys have been trying to do this a long time, hasn't really gone anywhere. So what's new?
mm,
And so probably not worth my while to look. Now, there's some truth in that, but a couple of points. One is that, in Herb Simon's day, computers were a billionth as powerful as they are now. We have vastly more data than we had then. And we've learned some things from the things we've done since the 60s. This has always been a fringe activity in economics, so there hasn't been a lot of person power thrust in this direction. I would estimate, it's 1,000th or 1/500th the work that's been done in the mainstream. So that's another reason progress has been slow. And I just think the time is ripe right now. So that's one reason. The other reason is mainstream people, they get educated a certain way, they learn to think a certain way, they believe that's the right way to think. This is completely different. It looks very foreign to them. So they go, well, this is just not the way you're supposed to do it. And economists are also very career sensitive. And so they go, well, this is not going to further my career. So the people who are doing it are generally brave iconoclasts who are willing to go out and buck the system and face the consequences of that. I think, there might also be a feeling among some economists that if this all works, then the intellectual capital they built is devalued.
sure, that which makes sense. And I will just add two things before moving on, is that, of course, I saw on LinkedIn that Bouchot, Jean-Philippe Bouchot, also is a great fan of the book, of course. And he said that he was reading it for a second in more detail now, paying attention to more things than he did the first time. But also about this was a big problem. There was a time when I was tangentially involved with some work with the Faculty of Economics here in Indiana University that had to do with complex networks. So we had a good group of networks, and in fact, one of them you mentioned, Alex Vespiniani, who used to be here in Bloomington, Indiana University, and then moved to Northeastern. But he was here, and we were trying to get in touch with people in economics and work with them on this different mechanism design and other things, which was even closer to their field. And I invited a faculty from MIT by the name Asuman Özdağlar, who is very active in networks with applications in economics, and whose husband, Daron Acemoğlu, got the Nobel Prize in economics this year. And so when I talked to her, she said that she knows really well, because of course her husband is an economist, that they are fanatically religious about their models. And it is not even that there is an alternative which may be perceived as a radical alternative, but even something that goes slightly above and beyond or below or to the side of their models and their perception of their model, they just have an allergic reaction to that. And they don't even want to see or entertain that. So I haven't seen that in mathematicians. I have seen it in computer scientists about programming languages. They are very fanatically religious about that. But economists apparently tend to be like that. And I don't know if it is discipline, as you said. Maybe they feel like they have invested so much that by admitting to something outside the model, the whole structure will collapse, perhaps.
Yeah. I mean, the difference with computer scientists is there are lots of computer languages, and some
Exactly.
people champion this one, other people champion that one. And economics theory is all done the same way. There's one way to do it. It's my way or the highway.
So one thing I want to ask, and then I will open it to audience, is that on page 45, you say this equation, economics equals accounting plus behavior.
Mhm.
So what that triggered in me was, how do you see then this other group that presumably one can count among the allies, like the type of Taylor, Schiller, people in behavioral finance, behavioral economics. Do you see them as resonating at the same wavelength as you and your approach, or is it something that can be capitalized, leveraged in this confrontation?
Well, you're asking really good questions. You know, yes and no. So the yes is that I think that's, in a sense, exactly why this approach, or it's one of the main reasons why this approach has so much promise. Because economics is struggling, I would say, to incorporate what they've learned about behavior in the last 2 decades into the theory that's used by central banks and treasury departments and so on to build macro models and so on. And there are various experiments of how to do that, but so far nothing has gelled. There's no accepted method for doing it. And and my own feeling is that that's because the two ways of doing things are fundamentally incompatible.
Hmm.
If you assume rational expectations, then saying that people maximize their utility and you solve these equations to maximize everybody's utility, those assumptions fit well. And you throw in supply equals demand and you get a model. But when you have behavior, okay, now you have people still maximizing utility, but they have a model of the world that distorts their perception relative to rational expectations. So you're sort of, hampering square pegs into round holes, I would say. Now, so I think what we're doing, which involves simulation, which allows us to put in behavior with as much richness as is wanted. One of the problems is real behavior is complicated. And so to deal with that complication, you really need computer programs that just simulate, which it's not a problem. You just, change the assumptions in your decision-making algorithms. Whereas in the mainstream view, you have to somehow put it into equations that have to be kept simple, and there's no natural way to do it. Now, you mentioned names like Bob Schiller. Bob Schiller is probably a little bit sympathetic. You know, he certainly recognizes that we need to worry about things like narratives and so on. He's not really a hardcore quantitative modeler. And there's some other behavioralists, but again, they also have to be careful. Within the profession, it's dangerous to go too far outside of the corral, if you will. And also, the big names that you think of, like Schiller and Thaler and these guys, well, they're old. As Keynes famously put it, economics advances funeral by funeral. So, not that I'm wishing for their funerals. Those are nice guys. They've done great work. But, it's a very clear difference. Young economists, in my experience, are generally much more open to the
Mhm.
idea of exploring other paths.
Okay, so now everybody from the audience, anyone with any questions, please unmute and ask. Yeah, go ahead. Go ahead.
So glad to have you on the call. One question on agent-based modeling. So I've always found this approach very intriguing. Ever since I first came across Santa Fe Institute, and I did a couple courses on the website. But I think one thing that I struggle with is I've never found anything that seems very easy to get started. If I want to test my hunch, if I want to sort of maybe repurpose a demo for some situation I care about, or even tweak the parameters, I think there's like a Sugarscape demo on Santa Fe Institute that's done in Python. But overall, that seems somewhat dated, and I haven't really seen any more modern implementation. So I guess the first question, very hands-on practical question is, if I want to get better intuition about agent-based modeling in general, or maybe about modeling complexity economics in particular, what are some venues, some maybe projects that you could recommend? I'm a data scientist myself. I love to contribute and also learn along the way.
Yeah, I wish I could give you a better answer, frankly. People have put together agent-based models in NetLogo. It's very easy to do. So if you just want a little toy example, I think those are pretty easy to cobble together. Rob Axtell is sort of the guy who's done the most in agent-based modeling. He knows everything. And he's done agent-based modeling more general. I have to admit, I'm really focused these days on economics, complexity economics, agent-based modeling. And we are building some open source software that we hope people will be able to play with. We built a macro model that I don't think the code is available to download yet, but it will be available soon.
Is this at Macrocosm?
No, it's actually a joint Oxford Macrocosm project. We are going to be making some agent-based models available in open source for non-commercial use that we hope people will play with and contribute to. But, I'm not the best guy to ask this question to, quite frankly. There is another thing you might look at. There's a software package called AnyLogic that I think you have to buy. But I've heard that it's very easy to put things together, and I think they have nice demos and so forth. But I think it's not totally cheap. So anyway, sorry, I can't give you a better answer.
One very quick follow-up that don't mean to hog the airtime. There was one chapter in your book where you talked about modeling real estate transactions, I think around the great financial crisis around DC. And I find, that's a very good example if you start with some sort of believable, simple heuristic, right, of what the home buyers and the real estate agents, how they might price the properties and how they might shift the pricing over time. And I wonder, along those lines, do you see opportunity for, let's say, machine learning, and in particular, maybe something that's non-mainstream, so like symbolic regression that can look at data and instead of learning sort of an inscrutable neural network, but rather actually try to distill into sort of symbolic representation. It could be something simple, right? It could be something that's maybe not as precise as a neural net, but that's something that's maybe closer, that's understandable to humans. And then take that distillation back into to initialize a agent-based model that you can then go and test match against reality.
Yeah, a couple of comments. I mean, there are certainly plenty of opportunities for machine learning and agent-based modeling to interact. We're looking at using machine learning to learn decision rules for agents within our models. Some people are using large language models to try and create models of how real people think, not just to make the smartest agents, but to model what a real person would actually do. So those are both very interesting lines, sort of AlphaGo style learning where you let the agents just learn from playing against each other. And we certainly have used large language modeling to connect data sets and do a lot of different things to create synthetic populations. So the two work very well hand in hand. Now, it's a really interesting idea to use symbolic methods to get at the underlying logic. One of the famous agent-based models in economics is called Eurace. It's a fairly old one. They used, I can't remember what their language is called, but one of the things they could do is create logical models. So you could see an automata effectively that mimicked the model. The problem was those pictures were so complicated once the model was realistic that it wasn't very useful as far as I could see. But there may be nicer ways to do it that can capture higher level abstractions and leave the details behind. It would be a fascinating thing to do.
Right. Yep. Thank you.
You're welcome.
Ma'am, any other questions?
Yeah, I was wondering whether you can make economic work. What I think of as forecasting is like weather forecasting. And weather forecasting models, I guess, have been built. I don't really know much about them, but like in the book on chaos, you get these initial conditions and then things progress from there. But as the conditions change, and with weather forecasting, you've got thousands and thousands of sensors all over the world measuring various parameters. And, when you make a weather forecast, you can only really be certain of short distance into the future. The further out you get into the future, the less certain any forecast is. So I would assume that an economic forecast would be at least as complicated, and that if you're making a forecast with as complex as economies are, I think it's even more complex probably than trying to measure a weather system. How can you expect it to, project any more than what's going to happen tomorrow?
Yeah, a good question. Part of the reason my book is called Making Sense of Chaos, I am talking about that kind of chaos. And I spent a lot of time in writing the book researching how weather forecasting is done. As I mentioned in the book, I had a little bit of experience because I interned in 80, or I believe it was, with Ed Lorenz. And I give some stories about those interactions in the book. Now, there's an interesting parallel development of economic forecasting and weather forecasting. They both started around the same time, at least serious computer models that were used for forecasting in economics were introduced by Tinbergen in the 40s. And it was 1950 when John von Neumann started numerical weather forecasting with the help, recruited Jules Charney to help him do it. And, here we are 74 years later. And it took 30 years for them to break even with subjective weather forecasters, which was actually where we were when I was interning with Ed Lorenz in 1980. And he said, yep, we're finally breaking even with them and we're about to start beating them. And that's exactly what happened. Weather forecasts have gotten better. There's a kind of Moore's law for weather forecasting that says that every decade, the weather forecasts for day T become as good as they were at day T minus 1. So despite the chaos, they get more and more accurate. In fact, one of my most widely cited papers is called Forecasting Chaotic Time Series. And because chaos is a double-edged sword, because on one hand, it says there are fundamental limits, but it also says that stuff that looks random might have a lot more order in it than you think that you can take advantage of on the short term. Now, it's not clear if the economy is chaotic. I don't think it's nearly as chaotic as the weather. I mean, the Navier-Stokes equations they're a bear. Early in my career, I worked on them, so I know. The economy, I think, is actually much simpler. Weather really requires state-of-the-art computer power. And as you said, there's stations all over the world and satellites and sophisticated methods of data assimilation to take those satellite outputs and feed them in to the weather models. And by the way, one of my students, Blas Kulik, has a paper that is in his thesis. I hope we're about to put it out, basically importing those methods from weather forecasting to use them with agent-based modeling, because we think that's going to be essential. But the economy, whereas in weather forecasting, you need, I can't remember the numbers now, but you need really a lot of grid points. The economy, there's only 8 billion people. Even if you simulated all 8 billion people by weather standards, that's no big deal. There's, at most 200 million companies in the world that you need to worry about. And we actually have data about all of those 200 million companies. They're companies that carefully scrape data on everything. So we have a lot of data. The thing we lack that people who do weather forecasting is physics, right? Navier-Stokes equations are sort of the rock around which weather forecasting is built. That said, when you want to understand something like clouds or heat transport, those are still complicated. Like clouds, they still use heuristics to deal with clouds. So the analogy I like to make, though, is that if you compare current economic models, there's an aggregate representing all of the economy, one household in a typical model. In some models, there's a spectrum of a distribution of households, but it's like a one-dimensional distribution. Whereas in our models, we can do full demographically matched synthetic populations that incorporate education, age, race, gender, you name it. And so we can really go into great detail. If you tried to forecast the weather using an aggregate model, you get nowhere at all. So I try to argue that we need to mimic the approach that's been taken for weather forecasting. I actually think at the end of the day, the problem's easier, though let me throw in one more thing. In economic forecasting, you need to make conditional forecasts. That is, what happens in the economy is conditional on what we do. So if we change policies, we should expect the reaction of the economy will change too. But that's one of the main reasons we want to do it. We really want to understand the cause and effect. If we adopt this policy, where will it take us? If we adopt this other policy, how will that be different, where it will go, so that we get better guidance going forward? In the weather, we don't have to worry about that. It's just unconditional weather happens. Although with climate modeling, that is conditional on how much carbon dioxide we put into the air. Anyway, long answer, but that's a rich topic, and I devote a couple of chapters to it in my book.
Yeah. Yeah, I've read your book and I
Oh,
enjoyed it
thank
very
you.
much.
Thank
Yeah.
you. But maybe I realized I left out one thing. Yes, I believe we will see there is sensitive dependence to initial conditions in the economy. My conjecture will be that it's not as strong as it is in the weather, and that we nonetheless can still surpass existing models, at least over timescales of, say, up to 2 years, remembering that the economy goes much slower than the weather.
I mean, can you really take into account, though, all the unintended consequences? Because typically when you
Well,
make a change in the economy, there
well,
are all kinds of characters out there that may react differently.
yeah. Well, of course, these models are never going to be perfect. We just want to build models that are better than the ones that are out there now. And in macroeconomic forecasting, much like subjective weather forecasting, has stayed roughly the same in quality of the forecast for 50 years. Subjective weather forecasting up until 1980, basically throughout the 20th century, didn't improve that much. But so I think we can beat that. And we're not going to be able to take everything into account. We're going to make mistakes, but I still think we can do a lot better. A lot of things like the crisis of 2008 caused by high leverage, I think we would have seen that very clearly had we had the right kind of models. I think actually even some of the problems we're facing politically about what does immigration do to wages or what does outsourcing do, I think we can build models that'll give us better insight into what the real consequences of those things are. And by the way, those things don't require time series forecasting. Those are shifts in the statistical properties of the economy, and like climate models, which are also predicting shifts in statistics. So chaos per se doesn't make their job harder and doesn't put limits on what they can do. I think we'll find that similarly for economic questions that involve the kind of changes in behavior that you see with policies.
Yeah, so I guess one thing I'd really like to see is predictions made based on economic policies of, well, England, for example, and
Yeah,
have somebody make projections about where things are going to be like in 1 year, 2 years, 3 years.
yeah.
And it seems to me if you could do better than other economists, that would do a lot to, strengthen your case.
Well, that's exactly what I'm devoting my life to right now. We already have some examples that I think provide the proof of principle. Like in the prologue of my book, I talk about the effort we made to build a model to predict the effect of COVID on the UK economy, where in real time we got things right and we tested it. We tested several different versions of lockdown policies and looked at their economic consequences. The government picked the one that we recommended as the least bad, and the forecasts we made for that were good. Now, with my company, Macrocosm, we really want to reduce this to practice, scale it up and reduce it to practice so that we're making forecasts day in, day out, pulling in all the data, making the forecasts, expanding the quality of the models. It's not a small project. We've raised 6 million so far, but we need a lot more. We're making a lot of progress, but I think we're going to make our track record transparent. We're not going to hide stuff. And which, by the way, most economic forecasting companies, you ask them for their track record, it's hard to get. And we believe we can do better. And we think that's really the only way this is going to be accepted. It takes a model to beat a model. If you want to convince people that radically different ideas are worth pursuing, you've got to show them that they have value. But there's a chicken egg problem because you have a fringe effort that you've somehow got to do better than what the mainstream has been working hard at for 50 years. So employing a lot of bodies after that. We think we can do it, but it's not easy. I have the good luck that at Oxford I've had some wonderful students and postdocs, and so I think we have a great team working on the problem.
Yeah, okay, thank you.
Welcome.
So one thing I wanted to actually, I mean, there are several points, and I don't know how that will lead to a bifurcation from this point on with these questions there. But what you mentioned about the predictive power of the model, And also, you mentioned in the book, especially these questions that I have here are all on part three, the financial system part of the book. And there is also the prediction of technological progress and its impact on economic growth and, economic inequalities and climate change and all that. But both of these economic models, as well as predicting the technological progress, how do you see the adoption of that? You alluded to this, at least there was the example of COVID and the way that the government reacted to that. But how do you see this being adopted and being accepted by the policymakers?
Yeah, well, it's always one step at a time. The technology forecasting models that you mentioned have the advantage of being relatively simple.
Yes.
And so that's, in a way, a more developed part of our agenda. It's something that could have been done in mainstream economics too. It's a little bit different than the rest of the book because it's not agent-based modeling.
Right.
But it did involve a lot of thinking about what are technologies, what are the empirical rules they follow. So in that regard, it's a different approach than economists normally make. And it's so far been successful. It's a case where we already have a track record. The first prediction was published in Nature in 2010. I predicted that solar would get cheap as coal-fired electricity, and it did. Not many people did, but we're keeping our track record. So far, so good. And policymakers are interested in this kind of thing.
Mm-hmm.
Now, the policymakers don't like the technology for the time series models because they can't see themselves in it. They say, well, how do I affect things with policy? That's where it's important to make conditional predictions, because the predictions we're making sort of lump together the kind of policies and R&D and everything that's typically happened so far in the technologies we're looking at without having conditionality. We're doing both new time series work that looks at the national level instead of the global level and asks, conditional on this policy being enacted, how did things change? And the other thing we're building that we're really excited about is a model of energy investment, an agent-based model where we actually model the agents are individual companies. It's a literal one-to-one scale model that they're companies that you've heard of or that maybe you haven't heard of, but that exist. And we embed our technology forecasting models in there, and the decisions the companies make are about what technologies to invest in. The company says, should I drill another oil well or should I build a solar farm? And we have 25 years of detailed data that we can test those models against. And we're embedding a huge amount of domain knowledge about how the energy generation sector of the economy actually works. So we have everything we need to build a really good model because we have the data. We can micro-calibrate the model, which is something that's going to be radically different from what economists normally do. It actually gives us the initial conditions like the weather uses, the history about the decisions of the company that we have and their financials affect, and the prices of electricity and oil and gas and everything that we can embed in there gives us quite a detailed picture that we can then run forward into the future. And this is all conditional on policies that are adopted by countries. So we can model the whole world at once at microscale with the time sequences of policies that are adopted by all the countries through time. So it's an extremely ambitious model, but we think it's doable. And we hope to have a working version ready by April 2025.
Oh, well, very good. Very good. Fantastic. So I have a couple of more questions, but I wanted to make sure that I ask this one because especially for a community like ours, with around 2,000 or so members and almost all interested in finance in one form or another, and also active in doing either education or research. So within the view or aim of making complexity economics into a mature discipline, like economics itself, like the traditional economics itself, or simply as a matter of contribution or interest in the area. What type of research projects do you see that younger people can take on from various different fields that we can talk about in our community and we can encourage people to do, as well as what kind of educational contributions? Because you also mentioned many times in the book that basically none of these material are being taught, at least not being taught in the form or shape that is appropriate in any one of the mainstream economics departments or even complex system units in computer science departments for that matter. So what educational and research contributions can be made by communities like ours?
Well, many, I'm sure. It depends, of course, on what people are interested in. I mean, there are little pockets of complex systems education around. Rob Axtell's group at George Mason, courses on agent-based modeling. There are a few places that offer complex systems degrees, Göteborg in Sweden and so on. Not mainstream, but pockets here and there. Now, you mentioned before finance, and you mentioned Jean-Philippe Bouchot, who, I think he's an amazing scientist. I'm really honored that he was plugging my book and said he read it twice. I got some good comments for him the first time he read it, I should also say. And I think he's really shown the kind of things that physicists can do in finance, many other physicists as well, Rosario Montaigne, Gene Stanley, etc. But Bouchot's work really stands out because the domain knowledge is very deep and the level of the theory is very high. And they use whatever tools they have. There's a lot of problems in market microstructure, which I worked in for almost a decade. I like that because there's so much data. And so you can make empirical models. The drawback is that, well, at some point I decided what I really wanted to do was help the world. And I think the real ability to do that comes from a better understanding of macro and technology and climate change. So that's why I shifted my direction, because I think it matters more, even though it's harder to do. As I mentioned, we hope to have open source software in the future that other groups will be able to participate in helping us build or using themselves. My ex-student, Marco Pangalo, is teaching a complex systems course in the Politecnico in Torino. And he has some great notes that I'm hoping he's going to turn into a textbook one of these days. Not ready yet, but a lot of thought has gone into it. Again, I feel like I'm not giving you the best answer, and I should also, make a cautionary note. If you ever want a job in mainstream economics, you shouldn't go this direction. So you have to be brave to go this way. I do think that once the mainstream economists realize that they really need to do this stuff, the people who've been out in the wilderness doing it will suddenly become hot commodities. And my prediction is that that's going to happen in about a decade, 5 to 10 years. We'll start seeing that happen. But that's, okay, long story why I'm predicting that.
Yeah.
But I think it's of course better to do these things in groups, and one of the problems, there aren't very many groups that are really doing them actively. Otherwise, there's a danger of getting lost by yourself doing something that's, unusual to start with.
Yes, no, absolutely, that is correct. I mean, it requires that support, the infrastructure and the support of the community, at least more than one person.
Yeah.
More than one person doing that. So any other questions from the group here? I have probably one last question that I would like to ask. There are a couple of questions within this question, but when I was reading, again, you alluded to all of these in the book, but I wanted just to hear about this market ecology. And I thought that, I may be completely mistaken on this, but I thought that your work on market ecology and the model based on that were very productive or useful in the market microstructure research. But I'm not sure that that is the conclusion to be made that I made or the impression that I got. But in general, and that also reminded me, while I was reading, that reminded me of Andrew Lowe's adaptive markets hypotheses. And then funny thing is that like a few pages after that, while I'm reading and thinking, you in fact mentioned Andrew Lowe and the adaptive market hypothesis. So just to wanted to see if there is a relation, how deep is that relation? Again, we have somebody who wasn't quite a mainstream in his work. I think Andrew Lowe seems to be a completely mainstream trained economist, financial econometrist, or financial economist. But even from the beginning, he talks about the objections he had to when he was young and just after school, and had objections to efficient market hypotheses in front of FOMA and others, and that led to some ugly conversations and things like that, and jeopardized his career to some degree, from which he recovered. But so he had this intentions of going away from the mainstream. But how do you see that? How do you see that kind of line?
Yeah. Well, first, I really, Andrew's a good friend, and he also endorsed my book, which takes a little courage. And he manages to be mainstream, but also be very open-minded and do other things.
Exactly.
He's like my friend John Giannakopoulos also. So I always really value his thinking. And our interactions go back, well, a long time ago, actually, when I was at Prediction Company, we got to know each other a little bit. And then he subsequently started his own investment company that I invested in and so on. But we wrote a paper together. I'm trying to think when it was first published, in maybe 1998 or 9 in the PNAS. Basically, it was a manifesto, a short one, saying we need to really think this way. And maybe I should say a little more about what it is. And then let me say what market ecology is, and then I'll come back and talk about how that relates to the adaptive markets hypothesis. But certainly there was a dialogue between Andrew and me for a long time. So the market ecology idea I came up with while I was trading, because I said, what's going on here? What are people actually doing? Because I was reading the mainstream papers where they assume that the traders actually know the correct price, that they know the true value of the assets they're investing in. And to me, that just seemed silly because nobody knows the true value. I mean, in fact, there's a quote I paraphrase from Fisher Black saying, yes, I believe in efficient markets. The prices are within a factor of 2 of fundamental values 90% of the time. I believe that statement, okay? But that's not the way they do it in the literature.
No.
And so he was sort of sticking him with his stick when he did that. But so I said, okay, what's really going on? And what I saw is that people are, first of all, specialized. Traders do a specific kind of thing, and everybody's trading affects everybody else. If I buy an asset, I push the prices up, which affects everybody who holds that asset or everybody who's thinking about buying that asset. If you're a value investor, it makes the asset undesirable. If you're a trend follower, it makes the asset desirable. So that right away shows you that what happens in the market depends on who's active, who has the most money, who's out there at that point in time. And I argue that we saw this through events like the tech bubble, where the trend followers were dominant, leading up to 2000, and then the value investors finally. And so I argue that if we really understood who's out there, we would be able to understand what the market's doing and why it's malfunctioning. And which, according to efficient markets theory, which a large fraction, most of the literature is still based on, markets are perfect. By definition, they don't do things wrong. Gene Fama still believes that. Now, most people don't believe that anymore, strictly speaking, but models are still built around that assumption with, saying, okay, we know it's an approximation, reasonable thing to do for some problems. But if you want to understand why the market's really malfunctioning, then you really have to think differently. And the market ecology hypothesis allows you to do that, because then the answer is, well, let's see, who's trading? What do they do to the prices? How are they evolving through time? That is, who's acquiring money, who's losing money? And you mentioned market microstructure. You even see the mainstream people doing that, even though they don't say it, because there's a big, totally different thing between, say, a high frequency market maker and even somebody who's scalping off slow cancellations. Those are very different kind of strategies, do very different things to prices. So I think there is an increasing recognition that you do need to think about who's out there in the market, what are they doing, and why is the market failing when it's failing? Because we have some pretty dramatic examples, and they are not caused by rational expectations. They're caused by things like mortgage-backed securities or portfolio insurance or, you know, in the mortgage-backed security case, by having traders who were issuing mortgage-backed securities not understanding the collective emergent effects that would happen when housing prices went the other direction. So I think there is a lot to be learned by thinking about markets in a systemic way, where you ask, who are the players? What are the strategies they use? And how do they do that? And, you know, I have a couple of students who are just finishing at Oxford that have built a one-to-one scale agent-based models of the American stock market. I mean, 3,000 stocks and 10,000 funds. And those models kind of very crudely reverse engineer what the funds do and ask the question, and we use the snapshots that you get from what are called 13F filings. The SEC requires mutual funds to file their positions every 3 months. And so we can actually see what mutual funds that participate in the American stock market, it's still only like 10% of the trading, but we can see what they do and we can see how the market responded, and we can actually simulate that. And we found some very interesting things. One of my students just finished his thesis, another one is just wrapping up. And anyway, I think there's a lot of promise in that line of research, particularly for regulators, because regulators can track everything in detail if they want to. And they could build models that really monitored the financial system and threw up yellow flags when it's doing something that we should be nervous about. And they could really simulate in some detail what's happening. Now, of course, it's dangerous because that could be hugely profitable. So you're going to have to really wrap that up in a pretty carefully to make sure nobody abuses it.
And do you see this adaptive behavior then? I mean, tying it back to Lowe's work,
Yeah.
they're the
So,
form of adaptive.
yeah, Lowe sort of goes farther, talking about both the ways in which human psychology influence what's happening, and sort of opens up the agenda even wider than market ecology. I mean, I think I did market ecology first, started talking to Andy. He has extended the ideas in other directions.
I see.
You know, I've worked hard with my market ecology theory. I discovered after I wrote my first paper that just conceptual thinking and toy models were not going to convince very many mainstream economists. So since then, I've really worked to try and make these things more quantitative, and again, trying to build a model to beat a model. And with these two recent theses of my students, I think we've taken a step towards showing the predictive power of the hypothesis in a tangible, empirical way.
Yeah, you're right. Ultimately, I think that more than the mathematical beauty of whatever underlying structure is, or if there is these laws, mathematical laws or anything that can describe the behavior that one observes, much more than that, the empirical results will have the impact on the policymakers or the market participants or the economists themselves as well. Because one of the questions that I had, and we didn't get time to talk about that extensively, is what is really a model? I mean, what is a good model? Because I had the same conversation with Jean-Philippe, and he sent me lots of references. I said, I want to start a group, and I want to ask a very simple question. What is a model? What is a good model? And can you please send me some documents and work that you have done or you appreciate others have done and so on. But this is really a fundamental question. And in the book, you do mention that some people think, like especially the mainstream economists, that the goodness of the model should only be measured in terms of the accuracy of predictions. Yeah, that's the mentality. And so if one wants to beat them in their own game, then obviously that is the trajectory that you're kind of paving forward, that let's show them that this model will give you exactly what you worship in terms of a good model.
Yeah. You know, and what is a model I subscribe to? I really like the work of Jorma Rissanen, who says a model is a way of compressing information about the world. And that information compression and prediction are really the same thing.
Correct.
And that even suggests that the best model is the one that gives you the most compression, where you have to measure both how much information does it take to write the model down,
Mm,
And how much information does it take to write the deviations of the model's predictions from what actually happens down? And if you could do that, you could really find the best models. Now those two steps may sound easy, but they're in reality very difficult to do in practical settings.
mm,
But models are, it's a representation of the world. And a model is something that's good enough to give you some insight that you might not otherwise had. As I try to stress in the beginning of my book, in science, we take things that were previously random and we make them non-random. We actually reduce uncertainty through time. So a model is something that can reduce your uncertainty a little bit, that can make the world a little less random if it's good. Of course, there are bad models too, right? But a good model, a useful model, will in some way make a prediction about the world. It could be a qualitative prediction, and it will in some way reduce our uncertainty so that we can make better predictions about what the world is going to do. Perhaps conditional on actions. Now, it's interesting what you said. When you criticize macroeconomists by saying your models don't make good predictions, then how do you believe the inferences you're making about how this policy or that policy will affect the world? They say, well, models are also about explanation, and that's what we care about more. We don't care that they don't make such good predictions. So, my view is that you should be able to make good predictions about the world as it is, to make predictions about the world as it might be if you change something. And it doesn't, making predictions about the world as it is not a guarantee of predictions about the world as it might be.
Correct.
But it's a better start than not being able to predict the world as it is.
That's right. That's very true. Very true. Well, we are at time. Well, this was a very pleasant conversation. Thank you very much for your time. It was great talking to you and seeing you virtually in person. I really think that this is a wonderful way for younger generation, with the provisos that you mentioned, that if they intend to go to economics, then probably they should be more cautious. But I see more of these people coming from maybe these days computer science or other areas or mathematics or data science, with all these new disciplines emerging, whether in collaboration with economics or not. I mean, there is a new wave and new hope that people will just open up to different ideas and different approaches, however successful they might be. But if you don't try, you will never know. So it is really important to, and hopefully we will get there.
Thank you. And I really appreciate your thoughtful questions and discussion. It was an exceptionally stimulating interview.
All right. Thank you very much and have a
Thank
good
you.
night.